Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
In this video, we're going to talk about something that you might have come across in the papers, which is F&O investing. It's been in the headlines this week for a variety of reasons, and we'll get into that through the course of the video. So first, let's think about whether you know someone who is a day trader or who trades in futures and options. I would be surprised if you didn't know somebody who does this. It could be someone that you met at your gym, at the grocery store, it could be a neighbor or even a relative. All of us seem to know somebody who's spending a lot of their time in the markets. This was clearly not the case 10 years ago or even 5 years ago, because back then the attitudes towards equity investing were different. People looked at equity markets as a risky space to be in, and derivatives like futures and options even more riskier. In fact, after the global financial crisis, Warren Buffett called derivatives financial weapons of mass destruction. So the attitude was very risk off in this segment. What changed in the last 5 years? If we really spend some time thinking about it, the pandemic brought in a lot more retail investors into the equity markets. Some of them started in mutual funds, some of them started in stocks, and some of them have dabbled in F&O or futures and options as well. This massive shift of people moving to a different way of saving is what the finance minister has been referring to as a generational shift. So newer investors are looking at newer avenues for wealth creation, and this is largely a good thing. But we need to go a little bit deeper into understanding what is actually happening here. Are they really making that much wealth? If we go according to the findings from a SEBI study, we'd realize that only 10% of investors are making profitable trades in this F&O segment. And these returns are somewhere between 15 and 50%. So the remaining 90% of investors are actually making losses on their trades. And if we look at what the average size of this loss is, it's about 50,000 rupees. And this loss is excluding any transaction costs, which can amount to about 28% of the trade value. So really, the numbers are showing us that people are not really making that much money with these risky strategies. However, there has been a shift in the attitude. That is, people are willing to take on more risk today than they were 5 years ago. We all know that trading is risky. But what many of us fail to acknowledge is that it can be a very demanding investment activity. It requires our constant attention, and we must have a very clear exit strategy if we want to be profitable in trading. This is wisdom that comes from this amazing book on taking risks and wealth creation called the Zurich Axioms. The one rule that they have is to always take your profits out early. This requires discipline, and this is something that we talked about in a recent video about the easiest mistake to avoid in today's market. The trouble with F&O investing is that it's a zero-sum game. So there are very clear losers and winners, and one thing that's caught the finance minister's eye is that retail investors could become the losers if the tide turns. In fact, in a recent conference this week, she said the unchecked explosion in retail and F&O trading can create future challenges, not just for the markets, but for investor sentiment and household finances. She also talked about the generational shift in the way that we're saving. So if we look at the people around us and how they used to save, India was predominantly a fixed deposit market. Most investors liked the comfort and predictability of fixed deposits. And then slowly they ventured into mutual funds. And in the last few years, there's been a dramatic shift from these relatively safer avenues into more riskier avenues where investors have started with direct equity investments and even in the derivative segment through F&O. So clearly the level as well as the nature of the risks that we're taking have changed. Indian investors have started taking on more risks of a very different nature. and the journey for the last few years has been very smooth. So many of us don't know what a down cycle looks like, and we don't know how we would respond to that situation. What we've seen in past cycles is that typically after a bubble or after this kind of massive change in the way people save happens, when there's a down cycle, many people are caught by surprise, and the surprise doesn't leave a good taste in their mouths, and they tend to stay out of markets for years together. Now, this is not a desirable outcome. The good shift has been that investors have started acknowledging equity as an asset class that can create wealth, but every asset class will go through cycles, which means that there will be phases of performance and there will be phases of underperformance. If we don't know how to manage the underperformance, we can find ourselves not participating in a great tool for wealth creation. So our key takeaway from all of this data is that it's time for us to practice a safer style of investing. This is something that we can help you with. If you'd like to know more about a safer approach to investing, do get in touch with us. Our contact details are here.